We're moving straight on to money, away from oil and back to money. The next panel, financing oil and gas projects in a low oil price world. And for this session, I'd like to invite Jan Prins, an independent consultant, an industry veteran, who will be moderating to introduce his panelists. Over to you, Jan.
A year ago, during the Oil and Money Conference, thank you very much. During Oil and Money Conference last year, the oil price was $52 a barrel. Today, during the Oil and Money Conference this year, the oil price is also $52 a barrel. So you might think that not a lot has happened, but as you know, last year, the last 12 months have been pretty eventful. And in fact, last year when the price was as low as $52 a barrel, it came almost as a shock to the industry. While today, now we are experiencing a price of $52 a barrel, it's almost a cause of relief for the industry. So indeed, a lot have changed, and among these changes is the fact that I believe that the industry has become more dependent on external financing, more dependent on bank financing, on bond financing, and also on new equity financing. Today, this morning, we're going to explore what has changed in both the industry and in both the financial sectors, how accommodating they are in this new environment. And I have an excellent panel of distinguished speakers, all bankers. And I would like to start with, let's say, from your perspective, to the left, Peter Goh, Global Head, Oil and Gas and Chemicals at Standard Chartered Bank. Julian Mylchreest, Global Head, Energy and Power at Bank of America, Merrill Lynch. And Ignacio de Calonje, Chief Investment Officer, Infrastructure and Natural Resources at the International Finance Corporation, IFC, which is the private sector arm of the World Bank Group. Our discussion, we want to break it into three themes. The first one is what is happening in the US, the predicament of the US shale producers or the small independent producers in general in North America. Secondly, we go to the international arena. What's the financial condition of the majors and also the other international oil companies and integrated oil companies operating worldwide? And thirdly, we go to the more difficult parts of the world, to the emerging markets. And because I think that on top of all the challenges, we have an additional challenge, and that is the increasing credit risk and political risk in some of the major oil-producing countries. Well, I think the first slide is already there. Although, of course, the oil prices and situation has hit rock bottom this year in North America, nonetheless, the experience for quite a few companies has been very brutal. As you can see here, the number of bankruptcies this year was up, both in terms of the number of bankruptcies and the volume of the amounts involved. But what is even more, and Peter perhaps will tell more about it, is that the recovery rates went down considerably. Like the oil industry, the financial sector speaks about recovery rates, which is basically the amount of the loan amount that you are able to get back in a difficult workout situation when your client gets bankrupt or when he's in default. Normally speaking, on average, on unsecured loans, it's about 50-50. You get back, you recover 50% and you lose the other 50%. However, what we've seen now is that those recovery rates that have been experienced last year by the sector in North America are far below the averages at levels that perhaps people a couple of years ago couldn't imagine. Peter, you're just back from Houston. What is the mood there amongst your fellow bankers and in the industry?
Well, I always think the key indicators in Houston is how full the restaurants and what is my house value today. And the restaurants are half empty and my house value is less today than it was 2 years ago. I think the story in North America is a story of the good, the bad, and the ugly. So I'm going to start with the bad. And it's been a very challenging 24 months in the North American sector. And I'm really going to focus on unconventional shale because obviously that's been a topic all morning. And I want to talk a little bit about the resiliency of shale. So it's not going to be all bad news. But the bad is in the last 24 months, we've had over 90 bankruptcies amongst the oil and gas space in North America. About $1 trillion of equity value has evaporated, and a multitude of billions in bank-related paper and other investor paper has also deteriorated. So, and how did we get here? I mean, and I always think it's important to see how you got here because we have 10 years of shale experience now, and the shale revolution is continuing, and we are, as bankers, are learning more and more. But first of all, how did we get here is one, we had the perfect storm. We had an industry that was going through a revolutionary change in shale that had an insatiable appetite for capital, number one. Number two, it was located in the perfect capital raising segment of the world, which is the US capital markets and bank markets. So liquidity was available and it was cheap. And the industry was demanding more and more. So what we ended up with was over-leveraged companies right at the turn of the cycle, and a cycle of which the marginal cost for unconventional was somewhere in the $70 range. I emphasize was somewhere in the $70 range, hence the resiliency of shale. What's occurred from a liquidity standpoint? First of all, the banks who operate in North America, which is pretty much all of the banking market. It's European banks, it's Asian banks, and it's obviously the US banking sector. That has been hit the hardest. And as Jan mentioned, the recovery rates on reserve-based loans historically have been in the 99th percentile. It was one of the safest forms of energy lending, even in the downturn of the 80s. And I was a young banker in the 80s, but I was too young and dumb to know what a downturn was at this time. And I've now concluded I think this downturn is worse, and maybe that's my age more than anything else, but we're certainly feeling the pain. But there's one difference between the 1980s and today for the banking market, and that's regulators. The activism of regulators in the banking market has really changed how the banks are reacting to problem loans. In the past, and I think the banks are very good about getting into trouble. We do it all the time, and we'll repeat it again in the next cycle. But we're equally good at getting out of trouble. So banks are very good at selecting who are the winners and who lives and who dies. Today, that's been taken out of the banking hands by regulators. And why is that the case? It's because the regulators have put down onerous capital provisions. And I'm not just whining about the regulators. This is just a fact of life that we have to live with now. The regulators put down onerous hurdles of which banks are forced to apply an increase in capital reserves associated with the condition of the loan. And they've set arbitrary numbers on leverage, for example, of a 3.5 times coverage. Well, all of these deals in the shale space are well in excess of 3.5 times leverage, and they're all in a situation where the regulators have forced banks to put virtually 100% capital reserves associated with them. And that forces banks to reevaluate the sector. So as a result of that, there's far less liquidity in North America among the banking sector today than there was 24 months ago. And I think banks are going to be very, very conservative as we come out of this cycle and into the next cycle, the upcycle of how many of their percentage of assets will be placed in oil and gas. Now, that's not to say there isn't liquidity available. There is plenty of liquidity still available in North America. We've seen a very vibrant equity market in the first 9-10 months of 2016, something in the excess of $10 billion of equity issued, which is the largest in the sector since 1999. And that has been a key element of liquefying many of the oil and gas companies in North America. So we also are seeing the development of different levels of capital. When we went into this crisis, we had not only first-tier RBL, reserve-based lending capital, but we had second liens, and in many cases we had mezz. The mezz disappeared, the second liens virtually disappeared, and the RBL recovery, as Jan said, is anywhere between 50% and 80%, depending on what type of credit you're in. I think what we're now seeing is we're seeing institutional lenders coming into the sector, developing unitranche structures, preferred equity that don't have ownership rights. So I think the industry is getting creative as we kind of move to the next phase of the cycle. Okay, the ugly. So what's the ugly? The ugly is Canada. Oftentimes, we in America forget about Canada, our northern colleagues. But the Canadian oil and gas sector, like anything else, when the U.S. catches a cold, Canada catches a flu. That's been the case in oil and gas. The Canadian sector has been hit much harder, both in terms of restructurings, in terms of liquidity, in terms of differential, and that their recession in the sector is a lot deeper than we've seen in the United States, and that will continue. The only differential in Canada is Canada's had a much more cooperative government that's been more, I'd say, more accommodating to the industry relative to a non-energy policy in the U.S. So what's the good? It's not all pessimistic. I would describe shale strategy over the last 2 years as, and I'm conjuring up Muhammad Ali here, is the rope-a-dope. Shale has successfully played the rope-a-dope for 2 years. And just like Muhammad Ali, it appears that OPEC has capitulated from a supply standpoint, and shale's now in the recovery phase. It's all location. Most of the activity in shale in the U.S. is in the Permian Basin. That's, Permian. I think we'll see the real recovery when we see other basins start to reemerge within the United States. I think the banks market is selectively adding growth capital now for the first time. We're seeing rig count coming up very slowly, but it is coming up. I think all bank capital is being directed to strategic players that are sustainable through the cycle, so they're going to quality. And we're seeing the new form of capital, institutional capital, come in that I think, and non-bank regulated capital. I think that's a very interesting component because non-bank regulated capital has a lot of advantages in terms of terms and conditions that banks can't provide. So the news isn't all bad. And I do think 2017 will continue to be a choppy market within North America. But I do think for the first time there's a level of optimism. So hopefully the restaurants will start filling up again, and hopefully my house value will go up.
Julian, do you agree with those observations?
Yeah, I think broadly. I think it's very much a haves and have-nots kind of world, right? So I think, as Peter says, that you've had, even a week or two ago, you had the first US IPO since, June 2014. It priced at the top of the range, traded up 15%. So look, again, for the right assets, I think people are starting to come off what's been a very long short on the equity markets. So I think if you have access to the equity markets, if you have access to the bond markets, then actually you have access to the bank market, because we as banks can see a path back to that 3.5 times kind of number. If on the other hand, you don't have access to the bond market, or you have it at twice the cost you did have before the crisis, you don't have access to the equity markets, then you also probably don't have access to the bank market, or at least when you come to refinance it and look for new money, as opposed to the banks hanging in with existing money, you're going to find it very tough. So I think it's the right way to frame it, but I think it's very much sort of haves and have-nots across the whole piece.
Well, we're talking about the haves and the have-nots, and then the alternative ways of funding. Last year we also saw quite a few companies that were in a very difficult, tight situation enter into restructuring, or the so-called distressed exchanges. I think that was perhaps just a postponement of the execution, or did it really help companies in trouble? Or just
in most cases, it just, I think, kicked the can down the road a little bit. Okay. And it's only those companies that have been able to finance enough to say, look, I'm fully funded for all I want to do in 2017, that have kind of seen the light at the end of the tunnel. So.
Ignacio, any comments on the US?
Well, as you can imagine, IFC is not an investor in the US, but we are seeing knock-on effects from what's happened in the US. Talking to international commercial banks, as Peter said, most international commercial banks have a significant US oil and gas portfolio. And when you talk to international commercial banks, most of the hits that they've taken on their oil and gas portfolio has been on the US part of their portfolio. And so the pain they're suffering in the US is trickling through to their overall oil and gas strategy and the appetite of their credit committees for emerging markets and international oil and gas, and leading them to really retrench towards core markets. So I think what's happened in the US is definitely having an impact on the markets that we cover, which are the emerging markets, in a very significant way, I would say.
Yeah, if you watch it closely, you can see that even banks, what they call the flight to quality, but you see capital and bank debt moving from one area in the world to another one, dependent on the situation. There was in the 70s a move to the North America, in the early 80s, and when then the price collapses, that moved away and so on. Perhaps you see something similar. I just want to come back to a quick comment. Yesterday, David Knapp mentioned that some people call the US shale situation the new swing producer, but he said that isn't true, because there is, all these producers, that's the market that determines eventually the production, and there's not a visible hand directing them to reduce or to increase production. However, you mentioned the regulator, and perhaps you could say that there's a small visible hand if you watch carefully, and that's the US regulator directing the banks. Is that a fair statement, Peter, or a little bit of an exaggeration?
I think that the ability of the banks to make independent decisions is extremely limited today compared to 2 cycles ago. It's just a fact of life, and it's not going to change. That's why I say I'm not up here and nobody's up here whining about the regulators. The regulators are a fact of our lives. But I think the market has to understand, and I think we have to be better disciplined going forward of how we approach financing. The one thing I'd also add is on the resiliency of shale. We've had 10 years of shale now in the U.S., and we have 10 years of managers who've been managing the shale. And I think it's a very important thing to realize that this is a different management culture than your traditional exploration management culture within the oil and gas sector. This is a management culture that knows how to bend the cost curve, phenomenally knows how to bend the cost curve. So when I was saying it was $70 break even, I'm not sure anyone knows what break even is for the Permian Basin right now, but I can tell you in the Permian, they're making money at $50 oil. They're probably making money at $40 oil. So this is an industry that has incredibly, you heard Rex talk about it earlier today, this morning, has incredible resiliency.
Just on the regulatory side, maybe the one thing I would say is if there is a message, I would argue it's probably the wrong message. So in the sense that I think we as banks don't need any guidance as to where we are at the kind of quality end. If you look at where the pressure is coming, it's by being forced to move away from a asset cover to a cash flow payout over a period of years, that 3.5 times number, and just generally putting the pressure on the smaller end of the market, which actually, if you were trying to manage the industry, you'd actually be trying to create some space at that end, because that's where you need the banks to play. So.
Well, let's move to the international sector, and let's move to the cash flow situation. If the graph that I just clicked on is visible, then what you could see is that also in the big oil, the large international oil companies, whether it's the majors or the other ones, traditionally the financial model, so to speak, was that of a self-financed industry. New investments were funded by operational cash flow. What we've seen lately for a couple of years, is that capital expenditures started to exceed operational cash flow. It was initially because of the cost-inflated high level of capital expenditures and the amounts involved, which already started to create a kind of a gap between cash flow and capital expenditures that needed to be funded. But that, of course, was, as you can see here, exacerbated by the drop in the oil prices and the much lower revenues and lower cash flows. It created a funding gap that needed to be filled. And of course, the industry has done a remarkable job in reducing capital expenditures and bringing it in line with lower operational cash flows, but nonetheless, what we have noticed in the last few years is seeing the amount of debt going up and up, seeing even the majors getting more leveraged. Just to throw one number at you, the total debt of 115 of the largest oil companies, the US and internationally, the total debt has increased by 1/3 to $400 billion US. Debt service requirements as a percentage of operational cash flow was also up. Julian, if you look at this picture, apparently the industry is becoming, it was always very, I mean, they're still not in junk bond area. It was always a very safe and low leveraged industry. But what do you think of those changes looking forward?
Look, I think if you look at the two levers that I think the big oil companies are pulling, which is access to the debt markets and disposals, and I think the availability of low-cost debt capital in such scale is really what, again, has accentuated the kind of haves and have-nots view. So, I mean, if you are an investment-grade name or you're one of the big majors, you have an abundance of capital availability, and frankly, you can push that as much as you want to manage your own kind of gearing numbers. I mean, you look at earlier this year, we raised $15 billion for Exxon. I think by about 10 o'clock, we had a book of about $36 billion. You look at the NOCs, Pemex, we raised $5 billion for them. Again, the book was north of $15 billion within about an hour of launch. You then come down the spectrum, it's a completely different game. So I think what we're seeing very much is that all the banks are very wide open in terms of committing capital to that quality end of the sector. There is, and the size end of the sector. That's also where there's massive availability in the debt capital markets as well. And I think that is a lever that people are going to continue to pull until such time as I think the disposal bid-ask spread starts to close. I guess a comment on that. I think if I look at the disposals we've been running, and look, there must be, you pick the number, but $200, $300 billion worth of stuck assets or assets that people would like to sell. It's probably more. I think if we look at the last 6 months, that has started, the bid-ask spread has started to come in. So I think an awful lot of things which we've been working on for maybe 18 months, 2 years, we're starting to see, I think, sellers move in a good sense, and one or two buyers now start to be ready to step up, maybe share some upside, think about kickers. So I think if you look at the two levers, I think the debt markets are still wide open for the big guys, and actually the disposal market is starting to turn. And again, back to what Rex Tillerson said, and I think it's the same if you look at what Total's been doing. If you are an integrated major, you have other levers to pull. So, it's helped Repsol to be able to do something on gas natural. You've had Atatec with Total, so I think those levers are also being pulled. So that would be my perspective. But again, to repeat my comment earlier, it's still very much, I think, haves and have-nots. If you think international oil companies that come down the size curve, you're in an even worse place than you are in the States, as Peter was describing. So.
But so indeed, of course, the big oil benefits from the fact that traditionally it's always been very conservatively debt financed. So there is room to change that. Nonetheless, equity is very important to them. So it's not only capital expenditures that need to be funded, but they also have dividend payments. What do you think about that? You think that will be?
Well, I think that is the ultimate sacred cow for, I think, most of the big oil companies, and it ultimately is what drives valuation. So if you said what is driving the valuation, I think pretty much of all the big oil companies, it is ultimately the dividend. I think when you look at what people are assuming, I think once you take account of the sort of scrip and the issuance of paper in place of cash, most of the majors are discounting back to around the 4% mark in terms of cash yield. So again, I think people look at some headline numbers and get concerned. That means the cash dividend is going to be cut. I think it's just more a reflection that most oil companies have turned on the scrip to manage through until such time as things start to move forward in a different place. So.
Peter, you agree with that? In particular, maybe you said that the banks are still there for the haves, the big haves with a capital H. But in general, for the oil industry, we always said bond markets are very fickle, but banks can also withdraw at the weirdest moment, and not only in the US, but also in the world global sector as well. And what is your opinion about?
Well, I think one of the things you've seen in the bank market, and I guess it's natural to do this. It's just a little bit strange if you think about it from a strategic standpoint. But banks all have a tendency to go back home, where they to their indigenous market during a difficult period. So if you're a French bank, you retreat out of the North America and you head back to Paris. If you're an American bank, you kind of move away from Europe and head back into the U.S., which is counterintuitive because you'd think that you'd want to diversify your portfolio a little bit more. But we've definitely seen a retreating of banks back into home markets, probably just to manage through the cycle as much as anything else and preserve capital and bring it back to where you are. And I think that's caused a dislocation of capital in many parts of the world. So, in the North Sea, for example, and certainly in the emerging markets, which Ignacio will talk about as well. So we've definitely seen a lumpiness of liquidity, to areas that are in need of liquidity and can't find it from that standpoint. I think the other thing that Julian mentioned is an important one, which is on the M&A front. There's a change in the dialogue in the first 9-10 months of this year. There's a much more active M&A market than we've seen. The bid offers are narrowing. There's creative ways that banks are coming up with to bridge that bid offer. 2015, buyers didn't want to inherit somebody else's problems. They had enough problems of their own, so there's a reason why you're selling. And companies weren't necessarily selling their crown jewels right away. So I think we're now seeing companies emerge that are looking beyond 2017. So I think we're starting to see real strategic thinking of what they think the industry is going to be like and where do they want to fill in not only asset positions, but management teams and other things that are open on the market. And I think that's a very encouraging sign. And I think, and flight to quality, you always run in these situations the quality. Lending money to ExxonMobil is not a really challenging thing for us on the stage here. I think it's when we go back into some of the more challenging areas, the emerging markets, and into the mid-cap E&P companies, I think that will be a real signal of a full recovery.
Julian?
I think if you go back, one of the instructive things, I think you look at, certainly in the US banks, if you were the JP Morgan CEO, our CEO, I think you were probably spending a good 20% of your one-on-one time when you were road showing our story as banks, telling markets and investors what your energy book looked like, because people were very focused on it. I think if you said, what does that mean? It means that everybody, I think, has been managing broadly to a kind of net neutral or even a declining kind of glide path of their overall commitment to the sector. If you then look at that book and you say that because of what the regulator's doing and just oil price, the risk rating of that book has got worse, which means we're carrying more regulatory capital, which is how we manage our businesses. By definition, the overall book is probably neutral to declining, and the regulatory book has got even more constrained, and therefore you are, once you're outside the obvious bets, you're having to be much, much more selective in terms of who the clients are that you were aligned with in banking. So I think that's the other big shift.
So the bottom line there is that in spite of the fact of the commercial banks moving to their home base or retreating perhaps a little bit more, and in general, there's no reason to be worried about finding the money for new investments that are needed not only to grow the sector but also to replace production that needs to be replaced and also needs to be financed. There are alternative sources, as you say, they are there.
If you've got good rocks and if you've got good projects, but that bar's gone up very, very high, I think.
So let's go to Ignacio, to the more challenging parts of the world and to the emerging markets. May I say one little thing is that, of course, we are going now to the oil exporting countries, especially those that are highly dependent on their oil exports. And what we've seen is with the drop in the oil prices is the fact that their income has come down. So most have a big problem in balancing their fiscal budgets, as you can see on the next slide. which means that there is also a lot of political and country risk pressures. Credit agencies have downgraded quite a lot of the oil exporting countries. Some of them, they're moved back into sub-investment grade territories, which means that financing energy in countries in Africa, Asia, or Latin America has become much more challenging. And Ignacio, you can tell us more about it.
Yeah, thanks, Jan. So just to clarify, as Jan mentioned before, I work for the IFC, so we invest in private sector projects, and we do that in both equity and debt instruments. Then we have our colleagues at the World Bank who provide advice and lend to governments, and we try to work together on projects in emerging markets. Maybe just to touch on sort of the liquidity situation, I think we've discussed a lot about commercial banks and their appetite. As we mentioned, I think there has been a significant retreat from commercial banks away from emerging markets back to core markets because of the issues they're having in terms of their overall global oil and gas portfolio, because of Basel III, regulatory pressures, et cetera, et cetera. So I think that's, we're seeing that very severely in emerging markets. So who's there? Who's still there to fund projects in emerging markets? We're still seeing a fair amount of liquidity from Chinese banks, and I will let sort of more informed Chinese observers tell me whether they think that will last and until when. But they do seem to be still very active in the emerging market space. We're seeing a lot of export credit agency activity. So export credit agencies seem to be really stepping up, whether it's the UK Export Finance out of here with a new deal with the GE, who's established their oil and gas headquarters here. We're seeing UKEF fund projects in Egypt and Ghana. They did a deal with Petrobras recently, etc. But other ECAs have also stepped up, the traditional Japanese and Koreans. So they're definitely filling a void in the market for big tickets, longer dated financing. And then there are the multilaterals, such as ourselves, who are also increasing their lending and their investments. I think EBRD last year had a record year. We had a 10% increase last year as World Bank Group, where I think we've lent about $61 billion. So again, I think multilaterals are stepping up in that area. So there are pockets of money available for emerging market projects, but as we mentioned, commercial banks are retreating, except for with prime clients. They are still there for prime clients, but it's definitely less than before. And then within emerging markets, I suppose there's always been, we've always distinguished between export deals and domestic sort of deals. And I think the theory was export deals were always easier if you could sell your oil abroad and had access to offshore accounts. Then from a structuring perspective, it was much easier. But I must say in the last few years, that distinction is less obvious, particularly as a lot of the projects that we're seeing are gas-related projects. I thought we heard Total earlier. Gas is a big focus, and we look at the commitments to COP21 and where countries are putting an emphasis. It's obviously renewables, but also gas. So we are seeing many more gas projects. And those gas export projects are becoming more and more complicated. We're seeing floating LNG type of project with the technology risk. We're seeing that LNG or that gas going not to Japan, not to Korea, but looking for a home in India, Pakistan, Jordan, Egypt, etc. So the credit quality of the off-takers has declined. And then the nature of the contracts is also much shorter. So again, those types of export deals still have a number of issues in terms of credit quality, off-takes, etc., that make them extremely complex. I think on the domestic side, when we're looking at where world energy demand is going to grow, it's certainly in the non-OECD countries. And again, when we looked at energy deficits, approximately half of the population in Africa do not have access to electricity. So the growth areas will be in emerging markets. And the structuring, the financing of domestic projects, domestic-oriented oil and gas projects, is a huge challenge. We're working actually with Standard Chartered on a project in Ghana with Vitol and ENI. How do you create a bankable project when the gas is going to be going to the domestic market for essentially power production, which will be obviously unsold to local customers, whether it be retail, industrial. The complexities of financing a project like that are immense, and we're seeing more and more of those types of projects. Because not only do you have to credit enhance the parts of the value chain that aren't credit worthy, but credit enhancement by itself is not sufficient. You have to look at the whole chain in terms of regulatory environment, and that there is a sustainable value chain all the way down. And I think that's why it's interesting, and again, I'm referring to Puyane's chat before, how oil and gas companies are realizing that, are trying to create markets, and that's where Total is really putting emphasis on the gas to power business and seeing how they can really tap into those markets. And there is a lot of orphan LNG these days, and if you talk to a lot of the majors, they are looking for homes for that LNG in these emerging markets. And so I think for us, I think the very positive and where we're seeing a lot of activity is in that midstream to downstream area, creating demand for that gas. We financed recently a project in Panama with a regas to power project. We financed a regas terminal in Pakistan. We're working with Accelerate in Bangladesh for a regas project there. Looking at pipelines, whether it's the East Mediterranean or other places. So really, I think with where gas markets have gone and with an excess of gas right now, companies are looking for homes for this gas. And so we're trying to see how we can work in financing these projects, these midstream to downstream projects, which I think is going to be a very interesting area going forward and a very complex area in terms of financing and how you structure these transactions.
Occasionally, there have been sometimes tensions in the past, both big oil companies but also commercial banks sometimes complained about IFC, World Bank. They are too bureaucratic, and if we can do it without them. But what I notice is that they need each other now, perhaps more than in the past. Is that a fair comment, Julian and Peter?
I hope so, yes.
I think so. Look, if you look at the complex projects, there's only one way you're going to make the move, right? Which is alternative capital, multilateral capital, or financing on the big balance sheets. The guys we've said earlier have got all the access to the capital. So I mean, that is right now. Those are really the routes forward, because the broader project finance is increasingly, I think, very challenged. So.
You can't get a deal done without an IFC or the ECA support. I mean, I think your description of bureaucratic and slow was probably accurate 10 years ago, but I have to give IFC a lot of credit. Working with them is a completely different experience. It may be the banks that are slow now, in some extent. I think the other thing that Ignacio raises is an important one. I think we paint this industry, my credit committees paint this industry, and the regulators paint this industry, and sometimes investors paint this industry with one brush. And if you look at the downstream business and the midstream business, it's actually quite healthy and somewhat countercyclical in some respects. So my sense is that capital needs to do a better job of differentiating between asset quality. I also think that in the international projects in very tough geographical locations, which is pretty much what Standard Chartered Bank operates in on a regular basis, the deals are structured better, in all honesty. I think the risk sharing is balanced. I think the mitigation of the less creditworthy entities is handled appropriately, and I think as a result, it manages through a cycle better. But let's be honest, financing indigenous African projects is not the preferred place for most banks, and we have a serious shortage of capital going into these markets. At one time, private equity kind of had a view on Africa and started developing funds, but quite frankly, we've really seen no real deployment of capital into Africa. We've seen a lot of banks get out of Africa in entirety, and we've certainly seen what looked like a promising local bank market in places like Nigeria really disappear now because of insolvency and loan problems that the local banks have. So any project we do in these emerging markets is difficult.
But the only nuance on that, I think, is if it's built pretty much anywhere in the world, you've got an excess of equity chasing it and an excess of capital and debt availability. If it's not built, to forget the geography, it's much tougher. So, and it's for me, it's when we look at the business, it's much less the geographical thing because we'll go anywhere. It's more, as you say, the right structuring and where it is in the cycle. So.
And that's one of the typical things, the nature of project financing, that indeed it's perceived also by the credit agencies initially and the regulators as high risk business, below investment grade. But what we found out after some time and some research is all the banks and Standard & Poor's and Moody's is that over the years the quality goes up. And of course it's natural. Once it's built, then you have a different set of risks. And then it's much easier to refinance and to tap into the right sources of funding. Yeah.
But yeah, and I think what's I think new in the last few years, and it's going to be increasingly that way, is the more and more the offtake or the market is a emerging market, and therefore, you know, as IFC, quite frankly, we can't compete with a JBIC or KXM in terms of the amount of money we can put. But the whole regulatory and the sort of softer aspects of how you structure are increasingly important. And it's not just about the money. It's, you know, Nigeria is a case in point. I mean, you know, to actually make a bankable deal in Nigeria for a domestic gas deal, you know, you have to fix and work with the government over a relatively long period to try to see, can you fix or can you make a bankable deal in, let's say, a Nigerian context or a Ghanaian context. So it is increased complexity, and it's going to be more and more that way.
And I think governments today, because of their own internal budgetary challenges, are much more willing to assist in solving the problems. I think that's one element that we've seen in the last 12 months, that entities are now very constructive, and I think that's promising.
Okay.
Malcolm Turner, Turner Mason, Dallas. All of you have mentioned regulatory restraints, and I've observed them. Do you believe that somewhat of restrictions have been self-imposed by the banks? Has that been your experience?
No, I think short answer. I think there's been, I think, a very heavy framework around everything we do, particularly in the US, and I think particularly for US banks. That means that you operate on that basis not only in your domestic market, but it travels globally. And I think actually where the US has led, I think most of the UK, Europe has typically followed. So I think what you've seen in the States, I also think will travel. So no, it's not us pushing it. I think it's absolutely the reverse.
The only thing I would say is, I think because of the banks are in such a defensive position, and we earned that defensive position because of the 2009 situation in the financial markets, we're probably much more timid of challenging the regulators on does that regulation make sense. And I hope that as we kind of move into the next 5 years, that there'll be more of a dialogue between banks and regulators as opposed to just imposing new regulatory restrictions.
And remember, it's not just the U.S. regulator, but also Basel regulations, which affects the capital buffers that banks need to maintain and their liquidity they have to maintain, which, for instance, is a big constraint to most banks to provide financing longer than, say, 7 years. Long-term financing is a critical element, and for the big projects in countries mentioned, you sometimes need long-term financing. If you can get it.
But I wouldn't say, I mean, I think obviously, I think banks have a lot of soul searching as well to do. I think the reality is in the smaller to mid-size space, we have over-leveraged companies. The oil and gas industry has traditionally been conservative. The majors have been conservative in terms of leverage levels because they knew very well the volatility and the cyclicality of the sector. And I think we've I think we have over-leveraged, and I think there is a bit of soul-searching internally in banks as to what's happened over the last sort of year or so, a couple of years. Well,
I think there's a final question. I saw a hand raised over there.
Hi, my name is Selene. I'm from Gas Strategies. And
You had to look it up on your...
And my question is for Ignacio, mainly. Basically, you are saying that credit agencies and kind of different financiers are now moving into project finance area in Africa. So how do they minimize their risk and exposure to project finance in these challenging areas? And also a more wider question, considering that you also said that banks are basically trying to stimulate demand in kind of like midstream and downstream sector. Do you think that banks in the future will also be kind of looking to work more with entities that don't have such a good credit rating, or countries that don't have such a good credit rating, like Pakistan or etc.?
So export credit agencies have been there in project financing for a while. I think it's just the sort of increasing the amount of financing that they have available for projects in emerging markets. I think the advantage they have is obviously they're part of a government policy to promote the exports of their country, and therefore tied to sort of content rules and all the rest. In addition to that, they aren't subjected to the same sort of regulatory pressures that commercial banks have. So I think they have much more freedom. And look, generally, as I think Peter was saying, these deals are well structured. So it's not as if they're sort of investing in junk projects. They are well structured. The reason why commercial banks aren't doing as much uncovered business in those types of deals is simply because of other internal concerns or regulatory pressures back home. So I think I think they're well justified to invest in those types of projects. And yes, I mean, in terms of investing more in below investment grade countries, I think banks and institutions will have to find a way to do that. And we're trying to see how World Bank we can play a role in that by providing partial risk guarantees for government offtake obligations, so we can, in a way, provide some credit enhancement for government offtake risks in places like Pakistan or Ghana, etc. So we're trying to see how we can find solutions to that credit risk. But yes, it's still going to be a challenge.
It is very complex, but basically, as far as the export credit agencies are concerned, of course they run huge political and country risk. At the end of the day, they offload it to their government, and they are prepared to take it when they see a good reason for it, like exports from their own country. I think we are out of time, and I would like to thank my panel, my distinguished panel, and please join me in applauding them.